This is Chuck Carvan. I'm the Chuck in the Markets Up Chuck, and today's blog is going to take a look at Sysco, the food service giant that was featured in Barron's magazine. And what I mentioned in the written part of my blog is this blog is dedicated to help the serious fundamental investor, identify potential candidates they might want to research for further investment. And I'm going to go through a presentation on Sysco here in today's blog to see if you feel that might meet those criteria. When you look at this company over the past 15 years since 1996, I want you to notice it's been a very consistent grower. It did have a down year in fiscal 2005, but actually has gone through the recession very well. And even with through two recessions, we've seen this company grow at almost 12% a year. The light blue shaded area represents dividend income, and I want you to notice that this company also has paid a very consistent and attractive dividend. You can see at the bottom of the chart here that their dividend has increased year after year. At today's value, they're trading at under 15 times earnings. The blue line here is the normal PE ratio. I want you to notice this company has generally traded at a premium price-earnings ratio historically, and this is the first time, going back through 1996, you actually see the stock trading below the green line. So, is that a good value? Well, it's certainly, good value based on history. The company, as I mentioned, had 11.9%, growth rate. But what's interesting is it's forecast by the leading analysts as reporting to First Call that follow this company to continue to grow at 15% a year. I'll let you read the Barron's article to learn why they like this company, but that's faster than it has grown over the last 15 years. So that could be very intriguing if it's true. When you look at Sysco's track record over the last 15 years, you'll see that a $100,000 investment on January 31st, 1996 would have grown to $335,375. That's a 9.1% rate of return during a period where the stock market would have only averaged 4% a year. When you add dividends into Sysco, unfortunately I can't do it for the S&P 500. My data doesn't provide it. But when you look at the dividend record of this company, as you can see, as they've increased their dividend, you would normally expect to start out with about a 1.5 to maybe, if you were lucky, 2% yield on Sysco. But as I mentioned, today you're starting out with a 3.6% yield. So based on its historical growth, you can see that a 3+% yield could actually increase very rapidly over time, assuming this company continues to grow in the future as it has in the past. So this is Chuck Carvan just pointing out that here's a company that has a good long-term history, a great dividend record, trading at a historically low valuation, and is expected to do pretty well going into the future. An extremely high-quality company. It does have a little more debt than I like, but for a dividend payer, this company generates strong cash flows, and I believe their dividend is well covered. You might want to check it out for yourself. This is Chuck Carvan saying thanks for listening. Talk to you again tomorrow.